Agarwal from Alchemy Capital Management joins us now to discuss the market fundamentals and his top sector picks. Alok, good morning and thanks a lot for joining in. This is a market that has had a remarkable move in the last many weeks and months. But your thoughts on which way things are headed now, considering that we have put a big rally behind us, do you think we can build on to these gains?
Hi, good morning. We definitely think we can build on to these gains. Definitely the last 1 year was a remarkable rally on the back of sectors, especially which had not done well for a decade or so. It's good to see participation coming back from other sectors as well. India is in a uniquely positive situation, both on the growth front as well as on the balance sheet strength front. So we do believe that there is more legs to this rally, and we are hopeful and positive on the markets too.
What about IT? If you could just get a bit sector specific now. Now, IT's had a phenomenal run. Since the month of June, we've seen the IT index give a return of nearly 30%. And this is despite earnings not picking up. In fact, if anything, in the June quarter, there were a few earnings downgrade. So this outperformance of Indian IT, which has now been close to about 18 months and particularly accelerated in the last 3 months, is largely because of PE re-rating. So the question is the IT rally justified? Does it make sense to buy in at current levels, or valuations are too rich?
You're absolutely right, Zima. The valuations are a little richer, especially on the sector as a whole. The index, the IT index could be trading somewhere around 28 times on a 1 year forward basis. And the estimates for the next 2 years, earnings growth stand close to 10% odd. If we divide the sector into multiple parts, the larger companies are more to do with the IT services. And these are the ones that are having a slower run rate on the growth side. But some of the software companies, some of the companies with products, those on the ER&D space, and as well as on the fintech platform space, some of those are experiencing quite a high bit of growth. So on the lower growth fronts, the higher valuations in our view is not justified. But the other ones which are actually having a higher growth rate as well as the growth visibility, we are positive on those things.
Okay. What about some of the new age platform companies, some of the consumption plays, some of the travel related stocks, whether it's the hotel names? Indian Hotels is up almost 4%, Indigo is at a fresh high. All of these new themes have done pretty well if you look at it in the last couple of weeks and months. Is there still more to go here?
Yeah, I would tend to believe so. So India as a country, the most structural theme in the country is the consumer discretionary plays. India stands at about $2,500 per capita income and are likely to double this number every 9-10 years. So it's a long runway of growth for the discretionary plays. Sometimes it is the manufacturers of those products. Sometimes it is the way those products or services are delivered. Those which can take the lead and have a very high market share and an increasing market share at a profitable balance sheet and the PL account as well, those are likely to do well. So some of the names that you mentioned, subsectors that you mentioned, they are looking pretty good, especially the ones that can come up the competition and get a thumbs up from the consumers.
So what's the way you have constructed your portfolio now? What is the weightage that you've ascribed to various sectors?
So I would say that we are more positive on the domestic cyclicals, and we have seen that this domestic cyclicals were not participating in the post-GFC era, more or less a full lost decade for them. And they're led by sectors like power, the whole value chain around there, even the real estate sector, the parts of all the Capex and manufacturing beneficiaries as well. And consumer discretion, as I mentioned, is the key overweight for a structural basis on India. But some of the sectors that were leading the rally in the past and are experiencing the slowdown in the earnings growth, those are the ones that we are underweight on.
Do you want to name them, your underweight sectors?
So the underweight on private sector banks and as well as the private sector NBFCs, also underweight on the staples and the large IT services names.
Okay, underweight on staples and large IT services names. Okay, got that. Any other themes that you'd be looking at? Because, there are so many themes which are picking up now, which is the focus area of the government as well, whether it's renewable energy, whether it's electric vehicles, whether it is a couple of other new age themes. Defense has been picking up a lot. But of course, some of these are overvalued as well. So anything else that you'd be looking at before we let you go?
In fact, you look at the power sector itself, that's one of the most surprisingly rising ones. And, it's one of the areas that government is focusing on, and rightly so. In India, we are in a unique situation. We experience our peak power demand twice a day. One is during the solar hours, and more importantly, the deficits come in the evening times. And going by the current rates, we are experiencing around 220 gigawatts kind of peak demand in the evenings. If that were to grow at about 7% over the next 5-7 years, we need to add 100 gigawatts plus kind of capacities on a PLF adjusted basis. And that's going to be quite a bit of an uphill task. The government plans to do so, and hence the Capex visibility in that segment and the whole value chain beneficiaries are quite a long list. Plus, the sector that is turning around the most is the real estate sector. We are quite positive on that. That's actually showing shades of more of consumer discretionary rather than what was made out of it in the past as a construction sector. So especially the luxury and the premium segments are doing extremely well. Inventory levels at probably all-time lows, and the demand both in volume and pricing doing well actually bodes well for the sector. So power and real estate are more positive. Defense is a long haul, maybe taking a breather after a big rally in the last year or so, but the visibility on the growth side for the next decade looks pretty promising.
How long do you think the real estate upcycle will last?
I would say we are possibly at the beginning of it. It's just a year or so that we have done well. Yes, the sector has done pretty well in the last 12-18 months. But even the nifty real estate index sector itself is below the peaks that we saw in 2007. So we do see a large amount there. The listed and the larger names are actually gaining market share. The pre-sales numbers are pretty good. And more importantly, an inventory level that used to be hovering at around 44, 45 months has come to all-time low of 12 months. So with the introduction of RERA, the introduction of GST net, and then at the same time, consolidation happening and market share being gained by the organized players, all have worked out pretty well over the last few years for the sector. Now, higher disposable income and the demand for larger space areas, especially as a catalyst, which COVID did, all these things are boding well for the sector, and the numbers are pretty strong.
Okay, the numbers are pretty strong. All right, got that. Thanks a lot for joining us. And have a great week, Alok. Thanks for speaking to CNBC TV18. Let's slip into a quick break.